Hi, welcome back to Books and Backbone. I'm Donna Harris, CEO of Bookkeeping Made Simple, your host. And today I want to challenge something that most business owners treat as obvious, that bigger clients are better clients. More revenue, more profit. The client who pays the most is the client worth keeping. Growth means adding more clients like the ones that generate the most revenue. These seem like obvious truths. They are not always true. And in some cases, in cases I've seen more times than I can count, they're spectacularly and expensively wrong. Today I want to talk about why your highest revenue client might actually be your least profitable one, and how to find out which one that is before it costs you any more than it already has. The client that feels like a win, every small business has one. They pay a large amount every month. They've been around long enough that you think of them as a cornerstone of the business. When someone asks how things are going, the client's part of the story. And then you do the math. Not the revenue math, the actual math. Time spent, costs incurred, support required, problems absorbed, scope creep accommodated, late payments endured, margin actually carried. And the number that comes back is smaller than you expected, sometimes significantly smaller. Sometimes when you add all of it up honestly, the margin is so thin that you wonder whether you're actually making money on this client at all. This is not a hypothetical. I've seen it happen repeatedly. A business owner who was working their hardest for a client who was contributing the least to their actual financial health. Not because the client was malicious, but because no one ever ran the numbers. So let me explain why this happens, because it's not always obvious. Revenue is visible. The invoice amount shows up clearly in your bank account, on your P&L, in the number you think of when someone asks how the business is doing. What doesn't show up automatically is everything it costs to generate that revenue. The direct costs are usually captured, materials, labor, cost of goods, but the indirect costs are almost never fully allocated, and that's where the gap hides. The hours of scope creep that weren't in the contract. The emergency calls at 7 p.m. that you handled because you value the relationship. The invoice that sat for 45 days before they're paid, tying up your cash while you wait and effectively giving the client an interest-free loan at your expense. The mistakes that required rework, the meetings that ran long, the team time that gets quietly absorbed into the relationship because the client expects it and no one has tracked it. Strip all of that out, allocate the real cost of serving this client, and the margin on your highest revenue client might be lower than the margin on your client that pays $800 a month, sends clear deliverables, pays within 10 days, and is never called outside business hours. Revenue measures what came in. Margin measures what you actually kept. These are not the same number. And as I'm thinking about it, I'm reminded of the first couple of seasons of Mad Men, where Lee Garner Jr., as the head of Lucky Strike cigarettes, is the most horrible client I have ever seen. And I watched those episodes wondering, why did they not rein him in? Why did they not say, I'm sorry, you don't run our business. You don't get to dictate who our staff is. I guess at that time that's what they did. But Lee Garner Jr. in Mad Men is a prime example of the highest paying client that they had that they were so scared to lose, who actually ended up costing them more than he was worth. And he ended up being taken care of. So the three clients every business has, every business almost always has these three types of clients. And once you do the margin analysis, even a rough one, the first client is the genuinely profitable client. They pay well. They're easy to serve. The work is clean. The relationship is low friction. And when you calculate the margin, the number reflects the revenue. These are the clients you clone. They're the clients you love. You clone them. These are the ones that you build your marketing around them. The ones whose profile you look for in every new prospect conversation. The second type is the marginally profitable ones, but worth keeping client. The relationship has value beyond the immediate margin. Maybe they refer consistently, or they provide stability during slow periods. They're growing in a direction that will eventually benefit you. Those clients stay, but do you understand what they're actually worth? You're keeping them for a reason, not one of inertia, or not out of inertia. You're keeping them for a reason. But the third type is the quietly costly client. They pay an invoice that looks healthy on the surface, but when you account for everything, time, support, rework, late payments, emotional bandwidth, the Wednesday afternoon crisis that derails your entire week, gosh, I'm glitching again. Um, the margin is thin or negative or so close to zero that you're essentially working for free on significant portions of the engagement. Now, I've had clients like this. I've had clients that our office hours are 9 to 5, Monday through Friday, in whatever time zone, mostly in the mountain time zone, but that's what our office hours are. And I've had clients, and we're fully remote, so we don't go to clients. I've had clients request in-person meetings when their agreement specifically disallows that. I've had clients ask me to meet with them at 8 or at 6. And both times, I have a life outside of work. And so I refuse those. And I've had to end up getting rid of that client because it was the same client every time. She was just a quietly costly client. She didn't think she was doing anything wrong. And maybe part of the problem was I underbid on her. But she ended up costing me more in just the emotional bandwidth that it turned out not to be worth it. Most business owners can name the first type intuitively. They know who their best clients are by feel. What they almost never know until they run the numbers is which clients fall into the third category. So what I want to here's how to actually do this. And I want to be clear, this does not require sophisticated software or an accounting degree. It requires about an hour and a willingness to be honest. For each of your significant clients, do the following. 1, start with the revenue, what they paid you in the past 12 months. That's your starting point. Then subtract direct costs, anything that you specifically spent to serve this client. Materials, subcontractors, software licenses, travel, anything that was incurred because of this client. Then estimate the time cost. How many hours did you and your team spend on this client over the past year? I prefer tracking things specifically by client so that I can see this easily. Multiply that by your effective hourly rate, the hour of your time is actually worth when you account for what it costs to run the business. That's usually the number that changes everything because the hours of scope creep and emergency calls and extra meetings that didn't make it onto an invoice show up tight here. They show up right here. Then account for things like payment timing. If the client consistently pays $45 days late on a significant invoice, you're carrying that receivable as an interest-free loan. Calculate the cost of that, the interest you're paying on your line of credit to cover the gap, or the opportunity cost of capital that's sitting in receivables instead of working for you. What you're left with is your true margin on this client, not the revenue, not the gross margin, the real margin after the full cost of the relationship. Now, do this for every significant client. Rank them by true margin. I promise the ranking will surprise you. Once you have the ranking, you have 3 decisions to make. For the genuinely profitable clients, double down. These are the clients you want more of. Use their profile to sharpen your marketing. Look for prospects who look like them. Build your business around replicating this relationship. For the marginally profitable clients, decide consciously. Are you keeping them because the relationship has strategic value? Because they refer? Because they provide stability? They're legitimate reasons. But make the choice consciously, not just out of inertia. And consider whether there are changes to the engagement, pricing, scope, payment terms that could improve the margin without damaging the relationship. For the quietly costly clients, this is where it gets hard. You have a few options. You can reprice, raise your rates to reflect the actual cost of serving this client. Some will accept it, some won't. Either outcome is acceptable. The ones who accept it become profitable. The ones who leave free up capacity for clients who are. You can rescope, clearly define what's included in the engagement and what's not, and enforce those boundaries. Scope creep is almost never intentional on the client's part. They ask because you've always said yes. A clear scope agreement and a polite but firm, that's outside our current engagement, changes the dynamic. And by the way, I would even say, make it permissible to say no. Not just to you, but to your team. Tell them, this client, this is the agreement. And if a client asks for things outside of that agreement, absolutely you can do it, but it's outside of the agreement and there's additional fees incurred. Or you can make a strategic decision, and I mean strategic, to let the relationship run its course. No confrontation, not a dramatic offboarding, but a quiet decision not to renew, not to take on new work, and to use that capacity that frees up to pursue a client who fits the first category. Now, none of these are easy conversations, and I'm not going to lie to you and say that they are, but they are worth having. I want to close with something I think is the most important takeaway from this episode. Growth is not always what it looks like. A business that adds $3,000 a month in revenue from a client who costs $2,000 a month to serve has not grown in any meaningful way. It has gotten busier. It has added complexity. It's created capacity constraints that will make it harder to take on a genuinely profitable client when one appears. The businesses that scale well, the ones that go from $5,000 a month to $20,000 or more to something bigger without burning out their team or losing their margins, are almost always the ones that have done this analysis. They know what their best clients look like, and they build deliberately towards more of them. And they are ruthlessly clear about the difference between revenue that grows the business and revenue that just keeps them busy. That clarity always starts with the margin analysis. What starts with clean current books can actually show you what each client relationship is costing and contributing. If you don't have that visibility right now, if the answer to what's my margin by client is I'd have to figure that out, that's the thing to fix first. The client who pays the most is not always the client who's worth the most. The client who is worth the most is the one whose margin after everything reflects the value of the relationship. Find out which one you have, then build toward more of them. If you want help running this analysis, or if you want someone to look over your client mix and tell you what they see, I'd love to have that conversation. You can find me at mysimplebookkeeping.com. The first call's free. I'm Donna Harris. This is Books and Backbone. Know what your clients are actually worth. And if you enjoyed this episode, and if you found it useful, if I gave you some good information, please like, share this with another business owner that you think could use it, and subscribe to my channel. On YouTube, hit the red notification bell so that you get notified when a new video uploads. I'm trying to do these every day. And I'm trying to batch them through, so I have new content every day. So please feel free to like, share, and subscribe. Help me grow my channel. I am putting a lot of work into this, and I really hope that something that I said was useful to you. Thanks for watching.